Have you ever stopped to wonder how some businesses don't just survive, but absolutely thrive decade after decade, building incredible value, seemingly over the long haul?
Hmm.
It's more than just luck. It's about understanding something really fundamental.
It is indeed. And often the blueprint for that kind of enduring success lies in grasping core financial and strategic principles and applying them with, well, unwavering patience.
Exactly. And that's what we're lighting up today on Book Talk. Finance. Get ready, because we're diving into a real gold mine of business and investment wisdom. The Berkshire Hathaway Letters to Shareholders, specifically the remarkable insights shared from 1965 all the way through 2012.
Right. And these aren't your typical dry annual reports, are they? Think of them more like a direct line to the thinking of, well, a legendary investor and business mind, offering timeless lessons that hold true no matter what the economic weather is like.
Welcome to our platform. This is where we're all about getting to the heart of crucial financial and business conversations. And today, well, we couldn't have a better guide than the author of these letters, the chairman of Berkshire Hathaway.
No.
He's famous for his rock-solid, long-term investment approach and, honestly, a knack for explaining even the most complex ideas in a way that just clicks.
Precisely. His ability to take intricate business concepts and make them accessible. That's a huge part of why these letters have become such a cornerstone in the world of finance, a real touchstone.
So buckle up for Book Talk, where we're going to unpack some of the really key, lasting ideas from these incredible Berkshire Hathaway letters to shareholders. Okay, let's get right to it.
What absolutely jumps out, right away, is the sheer scale of Berkshire's growth over this period. It's almost hard to believe.
The numbers truly tell a powerful story. Starting with a per-share book value of just $19 in 1965.
$19. Yeah, $19. And it exploded to $78,008 by 2007, and then kept climbing to $114,214 by 2012. That initial 43-year run saw a compounded annual growth rate of 21.1%.
Which isn't just good, it's phenomenal. It really hammers home the sheer force of consistent, patient investing, doesn't it?
Absolutely.
And it wasn't just about picking the right stocks, was it? It feels like their strategy broadened over time.
Oh, absolutely. While early on investment selection was key, you definitely see a very deliberate shift over the decades, a move towards building and acquiring entire operating businesses.
Right.
The fact that their portfolio of non-insurance companies grew from, what was it, 66 in 2007 to 68 not long after,
Yeah.
that really underscores the strategic evolution from primarily an investment vehicle to a diversified operating powerhouse.
Okay, and here's where it gets really interesting. Because even with that incredible history, the author keeps a remarkably grounded perspective about what the future might hold.
That's such a crucial aspect of his communication. There's this clear understanding shared with shareholders that replicating that phenomenal past performance is highly improbable, maybe impossible,
Right.
simply because the sheer size of Berkshire's assets and earnings has become so much larger. It's a welcome dose of realism, I think, even amidst such extraordinary success.
Now, beyond just the impressive numbers, a theme that consistently pops up in these letters is the absolutely vital role of the people running these businesses, the management teams.
Oh yeah, that's a non-negotiable for Berkshire. Able and crucially trustworthy management isn't just a nice to have. It's a fundamental prerequisite for any business they consider bringing into the fold. They're not just looking at the business itself, but really at the individuals leading it.
And it's not your typical corporate setup, is it? These aren't just folks chasing the next big bonus or something.
Well, what's truly fascinating and maybe a little unusual is the unique character of many of Berkshire's managers. A significant number of them sold their businesses for substantial fortunes.
Huge fortunes.
Exactly. But they continue to run them with passion because they genuinely love what they do, not purely for the financial rewards. That kind of intrinsic motivation is an incredibly valuable and somewhat rare asset.
And their approach to bringing these companies in seems quite hands-off, really trusting the leadership that was already in place.
Exactly. A cornerstone of the Berkshire philosophy is retaining the existing management teams after an acquisition. This provides crucial continuity and, well, it leverages the very expertise and leadership that made the business successful in the first place. Makes sense, right?
It does. So when they're looking to expand their operating earnings, strategic acquisitions are a major part of the plan. But they have to be the right kind of acquisitions, not just any deal.
Precisely. The letters stress the necessity of large and critically sensible acquisitions to fuel continued growth. It's not about simply growing for the sake of growth. It's about finding businesses that fit their specific criteria and their long-term vision.
And there's a fantastic story in the letters, isn't there, about the acquisition of Marmon that really illustrates their unique approach to these kinds of deals.
Oh, the anecdote of the Marmon acquisition is a prime example. Its origins can be traced all the way back to a seemingly unrelated 1954 Rockwood Chocolate shareholders meeting involving Jay Pritzker and a very unusual cocoa bean tender offer.
Wow, that far back.
Yeah. It just highlights how long-term relationships and observations can lay the groundwork for significant future decisions. It wasn't an overnight thing.
It almost sounds like a deal sealed with a handshake, but on a massive scale.
Pretty much. The Marmon deal with the Pritzker family was characterized by remarkable speed and a very high degree of trust. They were able to agree on a price based solely on the financial statements, without the typical army of advisors or, months of due diligence.
Incredible.
The established reputation and integrity of both parties were paramount. Trust was key.
So what does all of this boil down to when they're evaluating a business they might want to buy? What are the absolute must-haves? What's the checklist?
Well, the letters clearly lay out the key criteria for attractive businesses. First, it needs to be understandable within their circle of competence, as they say.
Right.
Second, it must possess favorable long-term economics, meaning a sustainable competitive advantage, a moat. Third, it absolutely must have able and trustworthy management, as we've discussed. That's huge. And finally, it has to come at a sensible price. Not necessarily cheap, but sensible.
And they have very clear preferences about the level of ownership they're looking for, right? It's not always about just taking a small slice.
Definitely. Their preference is definitely to buy the entire business or at least a controlling stake, say 80% or more. Especially if they view the existing management as valuable long-term partners. That alignment of interests is just crucial for them.
But they're also not against taking smaller positions in truly exceptional companies through the stock market, are they?
No, not at all. That's where the memorable Hope Diamond versus Rhinestone analogy comes into play.
Love that one.
Yeah. They recognize the immense value of owning even a small piece of a truly extraordinary business with enduring advantages, as opposed to having complete ownership of a mediocre business with limited potential. It's quality over quantity, really, in its purest form.
And there are certain types of industries they tend to actively avoid, too.
Yes, absolutely. Industries that are prone to rapid and continuous technological or competitive change, those are generally avoided.
Why is that?
Well, the reasoning is the fundamental lack of investment certainty in such constantly shifting environments. They much prefer businesses with what they famously call an economic moat, a durable competitive advantage that doesn't need to be continuously rebuilt. Think about it, some moats need constant dredging.
Right. Constant reinvestment just to stand still. That makes perfect sense. It's all about identifying and investing in lasting value. And while having a superstar CEO is a huge benefit, they don't want a business that's entirely reliant on just one individual.
Exactly. While they certainly recognize and value terrific leadership, who wouldn't? The ideal business should have inherent strengths and a strong foundation that isn't solely dependent on a single person. This just provides much greater stability and longevity.
Okay, now these letters aren't just abstract principles. They really bring these ideas to life with concrete examples of businesses within the Berkshire family. Let's maybe dive into some of the success stories.
Yeah, good idea. J. Ico stands out as a textbook example. A business with a very wide and defensible moat in the insurance industry.
A classic.
And that moat has been consistently strengthened and expanded under the exceptional leadership of Tony Nicely. The significant and sustained increase in their market share and strategic advertising expenditure since Berkshire's acquisition, it just speaks volumes about the power of that combination. Great business, great management.
And then you have Mid-American Energy, demonstrating impressive growth in a completely different sector.
Utilities, right. Right. Mid-American Energy's significant expansion, particularly in the realm of wind generation under the leadership of Dave Sokol back then, it showcases a long-term commitment to crucial infrastructure investment and adapting to evolving energy needs. And the remarkable turnaround in their pipeline's customer satisfaction rankings further highlights the tangible impact of strong, focused management.
Even in industries that might seem less exciting, like See's Candies, there's a compelling story of significant improvement there, too.
Oh, definitely. The impressive turnaround at See's Candies under the guidance of Brad Kinsler, with substantial and sustained profit increases in a relatively short period. It really underscores the effectiveness of placing capable and incentivized leaders in charge of fundamentally sound businesses, even something like candy.
And sometimes It's the seemingly small, practical suggestions that can make a huge difference, as we saw at Borsheim's, the jewelry store.
Yeah, that's a great little anecdote. Borshem's experiencing a significant sales increase simply by remodeling based on a suggestion from Susan Schock. It perfectly illustrates the value of empowering and listening to the insights of local management who are closest to the customers and the day-to-day operations. Simple, but powerful.
Okay, shifting gears a bit into the financial realm, Berkshire's ownership of Clayton Homes provides a really interesting perspective on the lending market, especially around the time of the financial crisis.
It does. Clayton Homes, as a major player in the manufactured housing sector with a substantial portfolio of loans, offers invaluable insights into lending practices, particularly to a segment of the population that's often underserved by traditional mortgage lenders.
Right.
And despite the cyclical challenges within the manufactured home industry, Clayton's consistently sensible and disciplined lending approach stood in stark contrast to the often questionable practices that plagued the wider mortgage market leading up to the 2007-2008 financial crisis.
It sounds like their borrowers, despite often having more modest incomes, had a much clearer focus on the fundamental ability to actually repay their loans, unlike some others.
That's a key differentiator, exactly. Clayton's borrowers prioritized affordability and the practicality of repayment rather than relying on speculative factors like continuous and rapid home price appreciation, which, as we all know, proved to be a major vulnerability in the conventional housing market. They bought homes they could actually afford.
Now, even the most successful investors make mistakes. And what's refreshing about these letters is the willingness to reflect on market events and investment strategies, including openly acknowledging errors. Not something you see every day.
No, it's not. The author candidly discusses investment mistakes made during 2008, specifically mentioning the purchases of ConocoPhillips and some Irish bank stock, frankly labeling them as unforced errors. That level of humility and rigorous self-assessment is quite rare at that level, and it offers valuable lessons for all investors, I think.
But that same period of market turmoil also presented significant opportunities, which Berkshire was exceptionally well positioned to capitalize on. They had the cash.
Absolutely. The strategic and opportunistic investments made in iconic companies like Wrigley, Goldman Sachs, and General Electric during that same turbulent period, acquiring both attractive fixed income securities and valuable equity participation. It perfectly illustrates the critical importance of maintaining ample cash reserves and having the conviction to act decisively when others are fearful and opportunities arise. Be greedy when others are fearful.
A classic line. And they have a very clear and consistent stance on certain complex financial instruments, especially derivatives. They're not fans, are they?
You're definitely not fans. The letters consistently express a strong and well-articulated caution regarding the inherent dangers of derivatives. They even recount Berkshire's own complex and time-consuming experience of unwinding General Re's substantial portfolio of derivative contracts after they acquired it.
Right, that was a huge undertaking.
Huge. And it highlights just how difficult these instruments can be to truly understand and manage, even for highly sophisticated financial players. If Berkshire struggled, imagine everyone else.
The topic of accounting practices also comes up in the letters, with a consistently critical eye on some of the methods companies can use to potentially distort the reported earnings.
Yeah, there's a recurring discussion on potentially misleading accounting practices. Things like the backdating of stock options or the often overly optimistic investment return assumptions used in calculating future pension expenses. These discussions raise important questions about the true reliability and comparability of some reported earnings figures and encourage a deeper level of scrutiny from investors. Don't just trust the headline number.
Now, shifting gears slightly again, the Berkshire Hathaway annual meeting, it's evolved into this truly legendary event in the global business community, the Woodstock for capitalists.
It really has. The sheer scale of the annual meeting, drawing tens of thousands of attendees, coupled with the unique offerings like the exclusive Berkshire weekend discounts at Nebraska Furniture Mart and Borsheim's.
You gotta get those discounts.
Haha, right. And the unparalleled opportunity to directly engage with the diverse array of Berkshire's subsidiary products. It makes it a truly distinctive and much anticipated experience. It's part business meeting, part trade show, part carnival.
And for a company of this size and influence, CEO succession planning is obviously a paramount and ongoing consideration, something shareholders always wonder about.
Of course. And the letters provide consistent reassurance to shareholders that Berkshire has been diligently and thoughtfully preparing for the eventual CEO succession. There's a clear identification of well-qualified internal candidates and robust backup plans in place. This proactive approach underscores their commitment to the long-term stability and continuity of the company. They take it very seriously.
When we talk about how Berkshire measures its progress over time, they often refer to the concept of book value. However, they're also careful to point out the inherent limitations of that particular metric, aren't they?
Very careful. While per-share book value is indeed used as a primary benchmark for tracking Berkshire's historical progress, the letters clearly explain that it serves as a somewhat crude proxy for the more critical measure, per-share intrinsic value, the true underlying economic worth of the business.
Which is harder to calculate precisely.
Exactly. It involves judgment. And they consistently point out that Berkshire's book value likely significantly understates its intrinsic value, particularly within its substantial insurance operations, because of the value of the float.
Right, the float again. It seems like there are certain types of businesses, even those with seemingly exciting and disruptive potential, that Berkshire consistently chooses to avoid.
That's a very deliberate and consistently applied principle. They actively avoid businesses whose future prospects and competitive landscape cannot be reasonably evaluated, even if they boast innovative products or services. Think cutting-edge tech sometimes.
So why avoid the exciting stuff?
Because the inherently unpredictable nature of competitive dynamics and technological shifts in rapidly evolving industries makes them less attractive for their long-term, value-oriented investment approach. They want predictability, that durable moat we talked about.
During periods of significant economic crisis and market downturn, like 2008, Berkshire has often played a rather unique and stabilizing role in the economy.
They really have. The letters highlight the crucial role Berkshire played as a significant provider of liquidity and essential capital during periods of acute financial crisis, most notably during that 2008 global financial meltdown.
Right, they were making deals when no one else could or would.
Exactly. By stepping in when other sources of funding were scarce or frozen, they provided a vital lifeline to several key businesses like Goldman Sachs and GE and reinforced their reputation as a dependable financial partner. They became the lender or investor of last resort, almost.
And despite its immense size and global reach, the fundamental operating philosophy of Berkshire seems surprisingly decentralized, not a huge controlling headquarters.
That's right. Berkshire operates as a distinctive collection of independently managed businesses with a highly decentralized decision-making structure. The parent company, the home office, primarily focuses on strategic capital allocation, overall risk control, the selection and compensation of top-tier management.
The big picture stuff.
The big picture stuff, yeah. While granting its diverse subsidiaries a significant degree of operational autonomy, they trust their managers to run the day-to-day.
They also seem to actively cultivate a very specific type of investor, one with a truly long-term perspective and a deep understanding of their underlying businesses. They don't seem to care much about short-term traders.
Not at all. The preference is clearly for investors who possess a fundamental understanding of the intrinsic value of the underlying businesses and who adopt a genuinely long-term investment horizon, rather than those who are easily swayed by short-term market fluctuations or fleeting analyst commentary,
Right.
They actively seek out shareholders who align with their patient and value-driven philosophy, people who are partners, not just stock renters.
And clear, concise communication, even when it gets distilled into brief sound bites by the media, is something they pay close attention to. The risk of being misunderstood.
Definitely. The letters illustrate how concise soundbite reporting can sometimes inadvertently misrepresent the author's intended message or nuanced views, using the economic outlook provided in 2009 as a prime example. It underscores the importance of understanding the full context and avoiding reliance on overly simplistic summaries. Read the whole letter, basically.
The insurance operations are clearly a cornerstone of Berkshire's enduring success, and that concept of float is absolutely key to grasping their financial strength. Can we unpack that a bit more?
Sure. The concept of insurance float. It's the substantial amount of money held from collected premiums before any claims are actually paid out, is clearly explained as a significant and enduring benefit to Berkshire.
Because they get to invest it.
Exactly. This float provides a massive pool of funds that can be strategically invested for their own benefit, often for years. And if the underwriting is profitable, which it often has been for Berkshire, the float essentially costs them nothing or even less than nothing. Geico and Berkshire Hathaway Reinsurance Group are highlighted as critical insurance operations that consistently generate substantial amounts of this valuable float. It's like a huge interest-free loan.
A massive advantage. Now, within Berkshire's wide array of holdings, the regulated utility and railroad businesses like Mid-American Energy and BNSF share some interesting and fundamental economic characteristics, don't they?
They do. The utility and railroad businesses are discussed as sharing key economic similarities. Things like providing essential services vital to the economy, requiring significant long-term capital investment in infrastructure, huge capital needs, and operating within a framework of wise and consistent government regulation. The idea of a fundamental social compact between these crucial businesses and the public they serve is also emphasized. They need to earn fair returns to justify massive investments.
Even businesses that initially faced significant challenges, like NetJets, the private jet company, have demonstrated impressive turnarounds under strong and focused leadership. That wasn't always a winner, was it?
No, it bled cash for a while. But the remarkable financial turnaround of NetJets under the dedicated leadership of Dave Sokol, transforming it from a significant loss-making entity into a consistently profitable operation. It serves as a powerful illustration of the profound impact that effective management and strategic restructuring can have on even complex and initially struggling businesses.
The letters also offer valuable and often prescient insights into the housing market, particularly in the critical lead-up to and the prolonged aftermath of the 2008 financial crisis. They saw some things coming.
They did. The significant imbalances and unsustainable practices within the housing market leading up to the crisis, as well as the subsequent protracted and challenging recovery, are discussed with insightful detail. And the letters draw that compelling contrast between Clayton Homes' lending practices in manufactured housing and those in the traditional site-built market, also highlighting the considerable influence of various government policies.
During periods of intense market turmoil and economic uncertainty, unique and potentially highly rewarding opportunities can emerge in fixed income investments, not just stocks.
Right. The author reflects on the ridiculously cheap valuations of high-quality corporate and municipal bonds that were available during the height of the 2008-2009 financial crisis. He openly expresses some regret at not having invested even more heavily during that period of widespread panic and fear.
Really? Even Berkshire missed some chances.
Well, it highlights the potential for significant returns when others are overly risk-averse, and maybe even they didn't fully grasp the extent of the opportunity at the time. Hindsight is 20/20, of course.
The valuation and financial reporting of complex financial instruments like derivatives also receive careful attention in the letters, beyond just the initial warnings.
Yes. The letters clearly explain the inherent potential for large and often volatile swings in the reported carrying value of derivative contracts. These swings can significantly impact a company's reported earnings figures without necessarily reflecting any corresponding change in their underlying cash holdings or fundamental investment positions.
So paper gains are losses that aren't really real yet.
Exactly. It highlights the complexities and potential for misinterpretation associated with these instruments and GAAP accounting rules. What's reported isn't always what's economically happening.
And the critical role that a company's board of directors plays in effectively overseeing and managing risk, particularly within financial institutions, is consistently emphasized, especially after 2008.
Critically important. The fundamental importance of the board ensuring that the CEO and the entire management team are fully accountable and responsible for implementing and maintaining robust risk control measures within financial institutions.
Yeah.
That's highlighted as an absolutely critical aspect of sound corporate governance and long-term stability. The board needs to own that responsibility.
Berkshire seems to adhere to a very clear and consistent philosophy when it comes to utilizing its own valuable stock for mergers and acquisitions. They don't like doing it much, do they?
Generally, no. There is a consistently stated reluctance to issue Berkshire Hathaway's own stock for acquisitions if the current market price is perceived to be inadequate relative to the company's underlying intrinsic value.
Why not?
Because it dilutes the existing shareholders. This disciplined approach reflects a fundamental commitment to preserving and enhancing value for their existing shareholders. They won't overpay using their own valuable currency.
Despite its significant and growing global presence, Berkshire maintains a strong and enduring commitment to making substantial capital investments within the United States. They talk about that a lot.
They do. The letters highlight the significant and ongoing capital investments made by Berkshire Hathaway in property, plant, and equipment within the U.S., billions and billions every year. It demonstrates a continued and unwavering belief in the long-term prospects and fundamental strength of American business and the overall economy, putting their money where their mouth is.
Okay, when trying to understand the overall intrinsic value of Berkshire, They break it down into several key and distinct components. Can you recap those?
Sure. Intrinsic value is discussed as comprising three primary components. First, the value of their diverse investment holdings, stocks, bonds, etc. Second, the significant benefit derived from their insurance float. And third, the earnings generated by their wide array of non-insurance operating businesses, think the railroad, utilities, manufacturing, retail.
And there's a fourth, more subjective part.
Right. The letters also acknowledge the inherent subjectivity in assessing the future efficacy of how the company will continue to deploy its substantial retained earnings. How well will they invest the money they keep? That's a judgment call.
And what are some of the enduring competitive advantages that have consistently contributed to Berkshire's remarkable long-term success? What makes them special?
Well, several key and reinforcing advantages are consistently cited. The exceptional talent and unwavering commitment of their operating managers, we talked about that. The unique and reinforcing Berkshire culture that fosters a long-term perspective and trust. And their demonstrated ability to make sound and effective capital allocation decisions over many, many decades, moving money to where it earns the best return.
The early history of Geico is particularly intertwined with the author's own formative journey in the world of investment and business. It goes way back for him.
It does. There's the personal anecdote of his initial, almost accidental encounter with Geico back in 1951 when he was just a student.
Right, he drove down on a Saturday.
Exactly, and the profound and lasting influence it had on his fundamental investment thinking and long-term strategy. It just underscores the importance of early insights and the long-term identification of truly exceptional businesses. It shaped his whole approach.
Ajit Jain's unique and highly successful leadership of Berkshire's reinsurance operations is also consistently lauded in the letters. He gets a lot of praise.
Deservedly so. Ajit Jain's exceptional and remarkably successful leadership of Berkshire Hathaway Reinsurance Group is consistently highlighted as a major and indispensable contributor to the overall strength and profitability of Berkshire's massive insurance operations. He's built something unique, taking risks others wouldn't, but understanding them deeply.
The diverse array of manufacturing, service, and retailing operations within the Berkshire family represent a broad spectrum of businesses, with many achieving truly outstanding results, even if they aren't household names.
Absolutely. The letters frequently mention the diverse range of businesses operating within these sectors, often highlighting specific examples of record-breaking performance and exceptional growth from companies like TTI, Electronic Components, Forest River, RVs, CTB Agricultural Systems, and H.H. Brown Footwear. It just demonstrates strong operational execution across a wide range of industries. Lots of quiet successes.
Even a seemingly modest acquisition like See's Candy has delivered truly remarkable returns on invested capital over the very long term. That was one of the early ones, wasn't it?
It was, and it taught them a huge lesson about the power of brands. The impressive and consistently high return on the initial investment in See's Candy serves as a compelling and enduring example of the immense power of acquiring good, understandable businesses with pricing power at reasonable prices, and then just allowing the compounding magic of time and strong management to work its wonders.
There are even some peculiar aspects of accounting related to certain acquisitions, such as with Marmon again, that don't necessarily reflect the underlying economic realities of the business. Accounting getting in the way.
Right. The unusual accounting write-down associated with the staggered acquisition of Marmon, which doesn't accurately reflect the strong and growing economic value of the underlying business, is noted as a specific example of how standard accounting rules can sometimes fail to capture the true intrinsic value of a company. Again, book value isn't always intrinsic value.
In more recent years, Berkshire has brought on additional talented investment managers, Todd Combs and Ted Weschler, and their investment decisions are now also reflected in the list of Berkshire's major holdings, part of the evolution.
Exactly. The inclusion and specific mention of investments made by Todd Combs and Ted Weschler clearly signals the ongoing evolution of the company's investment strategy. And it also represents a key component of their long-term succession planning for the massive investment portfolio side of the business, spreading the responsibility.
Now, the acquisition of newspapers might seem counterintuitive in today's rapidly evolving media landscape, yet there's a clear and logical rationale behind these decisions presented in the letters. Why buy newspapers?
Well, the seemingly contrarian acquisition of a portfolio of local newspapers is explained by the enduring value and crucial role of local news and community connection, particularly in smaller markets where the paper is the main source. The strategy focuses on maintaining strong, high-quality journalistic content while also adopting a sensible and pragmatic approach to their digital presence. They weren't betting on a huge print resurgence, but on community relevance.
And they highlighted specific people making a difference there, too.
Yes, the significant contributions of individuals like Stan Lipsey at the Buffalo News, who played a crucial role in its survival and success over decades, are also highlighted. Again, management matters.
Okay, Berkshire's dividend policy, or rather its long-standing preference against paying dividends, is a frequent topic of discussion and debate among its shareholders. People always ask about it.
Always. And the fundamental rationale behind Berkshire's long-held preference for reinvesting its earnings back into the business and pursuing strategic acquisitions rather than distributing them as cash dividends is thoroughly explained in the letters.
How do they explain it?
They often use a compelling hypothetical example of owning a private business. If the business can consistently reinvest its earnings at high rates of return, doing so will likely generate significantly greater long-term shareholder value compared to paying out those earnings as dividends, especially if the company's shares trade at a premium to book value in the market.
Because $1 retained can become worth more than $1 inside the company.
Exactly. If they can turn $1 of retained earnings into, say, $1.20 of market value, why pay it out? Plus, the non-dividend policy offers flexibility to shareholders with varying cash needs. They can just sell a few shares if they need cash, rather than everyone getting a dividend they might not need or want taxed. They mentioned Phil Fisher's ideas on this too.
And under what specific circumstances would Berkshire Hathaway actually consider buying back its own shares in the open market? They do it sometimes now.
Yes, but only under strict conditions. Share repurchases are considered only when two key conditions are met. First, the stock must be trading at or below a specific threshold relative to its book value. Initially, it was 110%, later raised to 120%. Okay.
And second, the company must maintain ample cash reserves after the repurchase. The overarching principle is crystal clear. Any share repurchase must demonstrably increase the per-share intrinsic value for the remaining shareholders. It has to be accretive to value, not just prop up the price. The overarching and consistent theme that permeates all of these letters, if you read enough of them, it's undoubtedly the critical importance of adopting a truly long-term investment and business perspective.
Absolutely. The letters repeatedly emphasize that short-term fluctuations and yearly performance figures should not be the sole or even primary focus for investors. Many of Berkshire's most significant and rewarding investments are made with a decades-long time horizon in mind, requiring significant patience and a willingness to look beyond the immediate market noise and quarterly earnings calls.
And ultimately, what is the enduring long-term goal that Berkshire strives to achieve in terms of its financial performance? What's the benchmark?
The stated long-term aspiration is for Berkshire Hathaway to achieve an average annual performance that exceeds the returns of the S&P 500 index by several percentage points over the long haul.
Not necessarily every year, though.
No, exactly. It's acknowledged that this goal will likely result in stronger relative performance during down or flat markets and potential underperformance during exceptionally strong bull markets, just due to their size and conservative nature sometimes. It's about the long-term average.
The letters also share some timeless and fundamental reminders about sound general business principles that are applicable to anyone, not just CEOs of huge companies, like ethics.
Definitely. The author consistently cautions against the dangerous everybody else is doing it mentality as a justification for questionable business decisions or ethical compromises. That's a huge red flag.
Right.
The importance of always erring on the side of caution and integrity when faced with ambiguous or potentially unethical actions is strongly stressed. Lose money for the firm, and I will be understanding. Lose a shred of reputation, and I will be ruthless. That's the message.
The board of directors' continued focus on ensuring a smooth and effective leadership transition remains a reassuring message for all Berkshire stakeholders, mentioned again and again.
Yes, the board's ongoing and dedicated commitment to meticulous succession planning, coupled with their confidence in the exceptional quality of the identified future leaders, provides significant reassurance regarding the long-term stability and future direction of Berkshire Hathaway. They want shareholders to know it's planned for.
The acquisition of Lubrizol, the specialty chemical company, is another excellent example of Berkshire adding a high-quality and strongly performing business to its already impressive portfolio.
Right, another big one. The strategic acquisition of Lubrizol and its subsequent strong operational and financial performance under its existing management team is highlighted as another successful addition to the Berkshire family, further diversifying its earnings power with another excellent business.
The recovery of the housing market following the 2008 crisis proved to be more challenging and protracted than many initially anticipated, including Berkshire's chairman.
Yeah, the author candidly acknowledges being incorrect in some earlier assessments regarding the anticipated timeline for a robust recovery in the housing market. It just underscores the persistent and multifaceted challenges that this crucial sector of the economy continued to face for years after the crash. Predicting macro is hard.
When considering the best strategies for long-term wealth creation, the letters offer a very compelling and thought-provoking comparison between investing in productive assets and non-productive assets like gold. This one is quite famous.
It is. The powerful analogy contrasting Pile A, representing all the gold ever mined in the world, with Pile B, consisting of all the productive cropland in the United States, plus 16 ExxonMobil-sized businesses. Well, it vividly illustrates the fundamental superiority of investing in businesses and assets that generate ongoing value and economic output.
What's the point of Pile A?
Pile A, the gold, just sits there. It doesn't produce anything. Pile B, the farms and businesses, generates dividends, crops, goods, services. The argument is that Pile B will vastly outperform Pile A over the long term for achieving real wealth accumulation. Productive assets versus sterile ones.
And the optimal time to strategically deploy available capital often runs directly counter to prevailing market sentiment, back to being greedy when others are fearful.
Exactly. The letters reflect on the dramatic shifts in market sentiment, from cash is king during times of fear to cash is trash during periods of exuberance. It underscores the critical importance of having a disciplined and contrarian mindset and being willing to strategically deploy cash when fear is widespread and asset prices are depressed. That's when the best bargains appear.
There are even subtle but important nuances in accounting practices that can sometimes obscure the true underlying economic picture of a business, beyond just derivatives.
Right. The letters briefly touch upon the distinction between real economic amortization charges, like a machine wearing out, and non-real amortization that results purely from accounting conventions, like goodwill amortization after an acquisition. It highlights some of the inherent limitations of GAAP accounting and perfectly reflecting the true economic value and performance of a business. You need to look through the accounting sometimes.
The accounting treatment of the Marmon acquisition is revisited later to further clarify the potential divergence between reported book value and the actual intrinsic value of that business.
Yeah. The significant and persistent gap between Marmon's estimated intrinsic value and its carrying value on Berkshire's balance sheet, primarily due to the specific accounting rules applied to the staggered nature of the acquisition, is explained again to illustrate how reported book value can sometimes significantly understate true economic worth. It's a recurring example of accounting not equaling economics.
Despite the inevitable short-term uncertainties and market fluctuations, the long-term outlook for American business and the stock market remains decidedly optimistic in these letters. A consistent theme.
A very consistent theme. A strong and abiding sense of optimism regarding the long-term prospects for American business innovation, productivity, and the overall vitality of the stock market is consistently expressed. Even while acknowledging that periodic economic challenges and market corrections are an inherent part of the economic landscape, the long-term trend is up.
And there's a direct and compelling invitation extended to CEOs who are hesitant about pursuing large value-enhancing projects due to short-term economic anxieties. A call to action, almost.
It really is. CEOs who might be hesitant to move forward with large-scale, strategically sound, and profitable projects because of short-term economic worries or Wall Street pressure. They are explicitly encouraged to reach out to Berkshire Hathaway as a potentially ideal long-term partner, someone who won't panic.
Okay. To summarize the core of Berkshire's enduring success, what are the key strategies they consistently employ to build per-share intrinsic value over the long haul? Let's recap the playbook.
All right. The primary and consistently applied strategies are reiterated as 1. Consistently improving the earnings power of their existing subsidiary businesses. 2. Making sensible and value-enhancing bolt-on acquisitions within those existing businesses. 3. Participating in the organic growth and retained earnings of their investee companies, like Coke or Amex. 4. Opportunistically repurchasing Berkshire's own shares when they trade at attractive valuations. And 5. selectively making occasional large-scale acquisitions that meet their stringent criteria. That's the engine.
Berkshire's insurance business has consistently been a remarkably strong and profitable performer for the company, not just generating float, but actual underwriting profit.
A huge achievement. The noteworthy accomplishment of Berkshire's insurance operations generating 10 consecutive years of underwriting profit at one point is highlighted as clear testament to the fundamental strength, disciplined underwriting practices, and effective management within this core segment. Most insurers don't do that consistently.
Geico's continued and significant growth in market share remains a key driver of Berkshire's overall success, even in the later years covered.
Absolutely. Updated figures demonstrating Geico's continued and impressive growth in its share of the highly competitive auto insurance market underscore its ongoing strength and competitive advantages. The gecko keeps working.
Mid-American Energy is rapidly emerging as a true leader in the crucial renewable energy sector, especially wind.
Yes, Mid-American Energy's substantial and ongoing investments in wind and solar generation are emphasized, positioning it as a leading force in the transition towards a more sustainable energy future. Huge investments there.
The Burlington Northern Santa Fe (BNSF) Railroad plays an absolutely vital role in the smooth functioning of the entire American economy. The letters really emphasize its importance.
They do. Updated statistics highlighting BNSF's significant share of intercity freight movement across the United States and its indispensable role in facilitating commerce and economic activity are provided. It's like the arteries of the economy.
NetJets, after its earlier troubles, successfully navigated its challenges and returned to a position of consistent profitability in the later letters.
Right. The positive financial results and the return to sustained profitability at NetJets in recent years, following strategic restructuring and operational improvements, are noted as a significant achievement and validation of the turnaround effort.
The long-standing strategy of focusing on strong, recognizable brands has proven to be exceptionally successful for several Berkshire businesses, revisited often.
Yes, the enduringly successful strategy of buy commodities, sell brands is revisited, with iconic examples like Coca-Cola, Wrigley, and See's Candy illustrating the power of owning and nurturing strong consumer brands with pricing power.
The housing market, while still facing challenges even towards 2012, is showing further signs of gradual recovery in the later letters.
Yes, a more recent perspective on the continuing, albeit gradual, recovery in the housing market is offered, acknowledging the ongoing progress while also recognizing remaining areas of concern. It was a slow climb back.
The significant decline in the purchasing power of the U.S. dollar over the long term has crucial implications that all investors need to consider. A sobering reminder.
Very sobering. The significant and long-term decline in the U.S. dollar's purchasing power since 1965 is highlighted as a critical factor. It underscores the importance of investing in assets that can outpace inflation in order to preserve and grow real wealth over time. Just holding cash is a losing game long-term.
And related to that, the environment for investing in bonds, especially around 2012, is viewed with a degree of skepticism and caution. Low yields.
Definitely. A quote from the astute investor Shelby Cullum Davis, referring to the bond market at the time as offering return-free risk, is shared as a concise and insightful commentary on the challenges of achieving meaningful real returns in that low-interest rate environment. You took risk, but got paid very little.
The long-term performance of gold as an investment is reiterated in comparison to productive assets, reinforcing the earlier point.
Yes, the long-term underperformance of gold compared to investments in productive assets that generate ongoing cash flow and economic value is once again emphasized. It's an insurance policy for some, maybe, but not seen as a wealth creator.
The popular Berkshire weekend discounts at the annual shareholder meeting continue to be a much-anticipated perk for attendees, right up to the end of this period.
Oh, yeah. The specific dates and details for the Berkshire weekend discounts offered at Nebraska Furniture Mart and Borsham's in conjunction with the relevant annual shareholder meetings are provided each year. Still a big draw.
And the Berkshire Hathaway shareholder meeting itself offers some truly unique and engaging activities for attendees beyond just the Q&A.
Right. The diverse and engaging activities available, like the traditional chess challenge with Grandmaster Patrick Wolf, magic performances by Norman Beck, and bridge games with renowned experts. They're all mentioned as part of the unique experience. It's more than just a meeting.
The efficiency and dedication of the small but incredibly effective team at Berkshire Hathaway's home office are acknowledged too. Not a huge bureaucracy.
No, famously lean. The invaluable contributions and remarkable efficiency of the relatively small team at Berkshire Hathaway's corporate headquarters are recognized as a key factor in the company's overall success, enabling the decentralized model.
Okay, in concluding our book talk on these letters, what are the absolute key takeaways regarding long-term investing that listeners should really remember?
Well, I think the core principles of patient, long-term, value-oriented investing. A relentless focus on understanding the intrinsic value of businesses, not just their stock price, and entrusting capital to able, ethical, and aligned management teams. Those are reiterated as the essential ingredients for building lasting financial success. It sounds simple, but it's hard to do consistently.
And the future leadership and strategic direction of Berkshire Hathaway appear to be in exceptionally capable hands, according to the letters.
That's the consistent message. The board's unwavering focus on and strong confidence in the well-planned and highly qualified leadership succession provides a final and reassuring note regarding the future stewardship of Berkshire. They aimed for seamless transition.
So if we had to boil it down to just one absolutely crucial takeaway for you, the listener, it might be this. Consistently focusing on the long-term fundamentals of a business, truly understanding its sustainable competitive advantages, its moat, and entrusting your capital to leaders with both skill and integrity. These appear to be timeless and enduring principles for building lasting wealth. Lessons that just shine through time and again in these remarkable letters.
Absolutely. That emphasis on a patient, disciplined approach, consistently avoiding speculative bubbles and always focusing on underlying intrinsic value.
Right.
It's a truly timeless lesson. It's applicable to any investor, really, regardless of their experience level or how much capital they have.
We wholeheartedly encourage you to seriously consider this long-term perspective in your own financial decision-making. And maybe, just maybe, take the opportunity to explore these Berkshire Hathaway letters to shareholders for yourself. They are a veritable treasure trove of invaluable business and investment wisdom gleaned from decades of unparalleled experience.
They really are worth reading.
And for more in-depth discussions and insightful book talks on other crucial finance and business topics, please be sure to subscribe to our channel. We love digging into this stuff.
We sincerely hope this exploration into just a portion of these truly remarkable letters has provided you with some valuable insights and maybe some food for thought on your own financial journey.
Thanks so much for joining us today on Book